Recessions often feel like chaos, fear, and uncertainty for investors. Markets fall, news spreads panic, and many wonder if wealth is disappearing overnight. But a recession is not just a threat, it is a signal, a reset, and an opportunity for those who understand its patterns. In this video, you will learn what recessions really mean for investors, how they impact portfolios, and how to position yourself to protect and grow wealth. Like and subscribe to understand how calm strategy outperforms panic in turbulent times. 1. Understanding what a recession really is. A recession is a period of economic decline, usually measured by 2 consecutive quarters of negative GDP growth. It affects spending, employment, corporate earnings, and investor sentiment. Many perceive recessions as catastrophic events, but they are natural cycles of an economy adjusting to imbalances. Economies expand and contract, markets rise and fall. Recessions are not punishments, but corrections that restore equilibrium, remove excess, and allow growth to resume under healthier conditions. For investors, understanding the mechanics of a recession is crucial. 2. Market behavior during recessions. Financial markets typically react to recessions before the broader economy shows full impact. Stock prices fall due to anticipated lower corporate earnings, tighter credit, and reduced consumer spending. Bond yields often drop as investors seek safety, while some commodities fluctuate based on supply and demand shifts. Market volatility is highest during these periods. Many investors panic and sell positions at losses. 3. Recessions expose portfolio weaknesses. Recessions act like stress tests for investments. Our portfolios overexposed to high-risk or cyclical sectors often experience sharp losses, while diversified and well-allocated portfolios weather turbulence more effectively. Over-leveraged investors may face forced liquidations. Recessions highlight the importance of risk management, diversification, and liquidity. They reveal weaknesses that may have been invisible during periods of expansion. 4. Opportunity in downturns. Recessions create opportunities for those prepared to act with patience and discipline. Quality assets often trade at temporary discounts as fear drives prices below intrinsic value. Companies with strong balance sheets, consistent cash flow, and durable competitive advantages become available at attractive valuations. For long-term investors, this is not a time for panic, but for careful analysis. 5. Cash flow and liquidity become critical. During recessions, cash flow is the ultimate safety. Investors with liquidity can take advantage of opportunities, meet obligations, and avoid forced selling at losses. Conversely, those overextended or highly leveraged may face stress, margin calls, or liquidation of assets at unfavorable prices. Maintaining cash reserves, safe income streams, and access to capital ensures flexibility and reduces pressure. 6. Long-term perspective matters most. Recessions are temporary by nature, and historically, economies recover over time. Investors who maintain a long-term perspective avoid emotional mistakes that erode wealth. Short-term losses often appear catastrophic, but patience and discipline reveal that downturns are opportunities for compounding gains. History shows that markets recover and grow beyond prior highs, often producing strong returns for those who stayed invested. 7. Diversification reduces vulnerability. Diversification across asset classes, geographies, and sectors is crucial during recessions. Stocks, bonds, real estate, and alternative investments react differently to economic stress. While equities may decline, bonds may rise or provide stability. Real estate may underperform in some areas, but remain resilient in others. Commodity prices shift differently depending on supply-demand dynamics. Proper diversification spreads risk and minimizes exposure to any single failure. 8. Rebalancing preserves portfolio health. Recessions can cause significant drift in allocations due to uneven asset performance. Stocks may decline, bonds may rise, cash positions fluctuate. Rebalancing ensures portfolios remain aligned with original risk tolerance and strategic goals. It reinforces discipline, enforces the principle of selling strength and buying weakness, and reduces emotional decision-making. Portfolios that are rebalanced systematically during downturns are better positioned to recover once markets stabilize. 9. Investor psychology is tested. Recessions test the mental fortitude of investors. Fear and uncertainty can trigger panic selling, herd behavior, or irrational decisions that lock in losses. Understanding that downturns are normal and temporary allows investors to maintain composure. Strategies based on rules, structure, and systems outperform emotional responses. Those who maintain calm, follow process, and resist the urge to react impulsively during downturns emerge stronger. Emotional resilience, patience, and discipline are as critical to long-term success as technical portfolio decisions. 10. Recessions reward preparation and discipline. The final lesson is that recessions are not punishments, but tests. They reward those who prepared in advance with cash reserves, diversified holdings, and disciplined systems. They reveal weaknesses in portfolios, processes, and psychology for those who neglected preparation. Investors who act strategically, maintain perspective, and focus on long-term outcomes benefit disproportionately during recovery phases. Understanding the cyclical nature of markets allows preparation to become advantage. Recessions separate the reactive from the proactive, the short-term focused from those building enduring wealth. Prepared investors do not merely survive downturns. Recessions are not moments to panic or abandon strategy. They are cycles to navigate with preparation, discipline, and patience. Markets recover, opportunities emerge, and disciplined investors gain advantage while the unprepared struggle. Understanding what recessions really mean for investors transforms fear into strategy and volatility into opportunity. Like and subscribe to continue learning how to build resilient portfolios, protect wealth, and thrive in every market cycle.